It all starts with how to know what to buy and at what price to buy to make the highest return. My name is Arpit Arora. I'm India's leading personal finance expert and passive income coach, and I'm on that quest to change the middle class of India and transform their financial life in such a way that they are able to have the potential to follow their passion. They have the focus to follow their passion. They are not distracted by money because they're creating enough passive income, and most importantly, they're able to live with inner peace and joy. And that, my friends, happens by winning the game of money. That happens when you upgrade your financial IQ, and that most importantly happens when you are committed to achieve financial freedom in your life, because it cannot happen without a commitment. And it is my commitment to make sure you get all the support that you need to walk and achieve that destination. Thinking of it like that, if anyone gets to know this science, you don't even need a job, because as long as you can keep on doing this quickly and faster and faster and faster again, then you will not have to do anything else. But there is a science to it. So as I go along, you will understand. Okay. So there are two things as we go in this. The approach, there are two ways of doing this. Either you go the fundamental analysis way, or you go the technical analysis way. Okay? One or the other approach. Either you go through the fundamental analysis or the technical analysis. Or you can also use a combination of the two. Now, what is fundamental analysis? See, fundamental analysis is the method of determining intrinsic value. Intrinsic value is also, you can say, the fair value or the true value of a company's security. Company security means a stock, you can say, to benefit from its trading. Very simple. So simply you're trying to know what is the worth of something. That is what fundamental analysis is. How is it done? You look at the macroeconomic factors like economy, industry, market share of that company, what economy they're in India, how is the industry that they're doing, let's say Britannia, so they're in the FMCG, how much market share they have, let's say 40%. So you look at these factors. This can tell you the intrinsic value. Another way of doing it is microeconomic, like you look at the management of Britannia, you look at their business policies, you look at how much earning they've done, and then you come to the intrinsic value. And once you've selected a certain company, let me just take you here and remove this. So once you've seen a certain company, you see if it is undervalued or overvalued. If, let's say, you found the intrinsic value to be 100, is the market price less than 100, then you buy it. If the market price is more than 100, you either sell or you refrain from buying, because if you already have it, obviously you sell it. If you don't have it, then you will wait until it comes to that point. Now, this is one approach. Another approach is technical analysis. Now, what happens in technicals? What I'm going to do here now is I'm going to take you on my screen and I'm going to go step by step in explaining this to you. Okay. You'll be able to see this in a mind map, a very beautiful way of understanding, and it will be very easy for you to remember as well. Okay. Are you all able to see my screen, by the way? Everyone, are you all able to see my screen? Can you see this mind node? Yeah. All right. So how do we buy at the right value? By doing fundamental or technical analysis. When I talk of fundamental, there are two ways to do it: qualitative and quantitative. Qualitative was what? Perception. Like I told you, company's goodwill, company's behavior, demand, and the company's recognition in broader markets. Like this is mostly when I say Tata Group, lot of people invest purely because of the goodwill of the company. Like the company is very philanthropic, right? They have good demand, the company is well known. Or there could be a quantitative way of doing it. Now I look at the financials of the company, the quarter performance of the company. I look at the balance sheets of the company. I look at how much debt that they have, how much cash flow they're creating. So mostly I give more weightage to quantitative, but qualitative also cannot be ignored, because there are a lot of other people who are buying purely because of qualitative reasons, like Tata, like for that example. So the price of the stock will still go up. Why? Or it will not fall as much. Why? Because the company's goodwill is so good, or the recognition of the company is so good that people still want to buy no matter if the price is falling. So that automatically will support the price, right? The second thing is number driven. Now, how can you look at numbers? So then you start looking at, there are basically three models that people use. Either they use discounted cash flow model. Here they try to figure out how much cash flow the company will create over the next 1, 2, 3, 4 years, depending on how the business is growing. Then they discount that cash flow, that if this is the amount of money this company is going to generate in these future years, this should be the value of the stock right now. This is called the discounted cash flow model. Another model is forward PE ratio, which means for the price of the stock, how much earning are they going to do in the future, right? Which is pretty much similar to discounted cash flow. They look at the future, not the past, not the current. They try to predict future mein kitna price, like let's say if the price is the same, how much earnings will they get? So once they get the analysts tell the future earnings, they try to figure out what should be the right price of the stock today. Ki agar future mein this company is going to make so much earning, the price of the stock should also go up and you can make a profit out of it, which is a forward PE. We've discussed PE ratio in I think 2 or 3 classes ago in much depth. So you can obviously go through that if you don't know what a PE ratio is. Another method is PB or P to EV ratio, which means price to book value or price to enterprise value ratio. We spoke of this in the context of Sensex in the class that we had, where we said that the price to book value is a better method to look at the valuation of Sensex, not just PE. So here we are trying to see the price against what is the worth of the company in books, or the enterprise value of the entire entity. So these are 3 methods through which people do quantitative analysis. So mostly fundamental analysis is based on quantitative. Most of the people use discounted cash flow and PE. Even PB or P to EV ratio is given a lot of significance. All of this is fundamental analysis. Now let's look at technicals. Technicals mein kya hota hai? This first thing is purely chart based. You cannot do technical analysis without looking at a chart. Now this chart can be in various forms. It could be a line, it could be a bar, it could be candlesticks, it could be Japanese candlesticks. There are 3-4 type of ways of looking at a chart. And you use tools to analyze. Now these tools, there are more than 200 available today. So what do you look in the chart when you look into the chart? You look at the price, you look at the volumes, you look at the pattern, and you look at the averages. Price, which is very clear, let's say 200 is the price. Volume means how many people are buying and selling at every given day, every given hour, every given week or month, whatever time frame you're looking at. Then you look at patterns. Pattern means what is the style formation? What is the formation of the chart? If it's going up, it's going down, it's upward, sideways, so on and so forth. So pattern could be, let's say, upwards. Or you can say it's going sideways. Or you can say it's going downwards. So all of those things. So that's also one thing that you can look at. Then we look at averages. Our averages, like there are tools called RSI, Relative Strength Index. You look at the average, or there is daily moving average, DMA. So all of these methods are used to see what is the average price of this stock in the last 1 year. Then they look at how much deviation they have. Let's say if the price of the stock is average 130 rupees in the last 1 year. Currently it's at 100. This could be a factor to buy. Or if the price is 200 for a daily moving average of 30, or not 30, but let's say 100, then also that's a factor to sell. So these are all different methods through which people do it. There are various tools, but today I will give you examples live on the screen of the tool that I give a lot of significance to. that is supports and resistances. Okay, so I'm going to take you on my screen and I will show you how supports and resistances come. Whenever support comes, basically it's a time to buy. Whenever resistance comes, it's basically a time to sell. But how does that work? In a chart, I will show you. Yes, I don't expect you to do technical analysis yourself. No, I'm not talking about that. But I want you to see for yourself how this thing works and how you can use it to the best of your benefit, if in case you want to have a look at it or understand this in a little more detail. So I'm going to take you on my screen and I'm going to show you the chart of Nifty 50%. Okay, so let's go on the screen and have a look at that. I'm going to enlarge this. This is the year 2007, 2008, 2009 period. When you look at this, let's say the chart had only built until this period. It's going up, it's going up, it's going up, 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 and up. By this time, now you see that the market had gotten to 6,100. From this came the biggest ever fall Indians had ever seen in the stock markets. The markets plummeted more than half. But once they did that, I want you to look at something very interesting. If you just mark this point and you zoom into this area, you will see that previously, this was a point from where this entire rally had actually begun. So this was a support area where, if you can follow my cursor, let me see if I can draw something for you here as well. Yeah, somewhere in this line here, this thing was actually a support level, because you can see the price trend actually started from here. The price went all the way up and it came all the way down to this very support level, and it consolidated in this support, and then it went up again. And when it went up, it went to its resistance. Where was the resistance? At the same point, 6,100, from where it had fallen 50%. Now this became a resistance point. And the market again fell a bit further, but this time not 50%, just 10-15%. The market fell from 6,000 here, and it again came to this point, and it again tested the level, and then it fell again. It again tested the level. This time it consolidated, and this created a breakaway rally. And this is something I had participated in myself, where the markets moved from 6,000 all the way to 9,100 points here, as you can see. So this line was a resistance line, and this line was a support line. And you can see these things over and over again. I can show this to you. This happened again in the year. This is exactly how we got to know during the year 2022 where to buy. This was a major support level somewhere here. For us, 9,000. This was the point. 8,900 something was a major pivot, because this was acting as a resistance. It touched this point, it went down. It touched this point again, it fell again. Now it broke this point. It went up, went up, went up, went up until this point. Now this is where COVID happened, and the price started falling like a free fall. We invested majorly around 9,000 levels, and in fact 8,100 levels, not 9,000, 8,100. So this was one pivot where we invested. The second pivot we invested was 8,100. Markets went up to 7,886 if I remember correctly, and it corrected back. And not only did we buy Nifty 50, we bought Nifty Junior, we bought Nifty Bank, we bought many indexes. And we started selling at around this point. From here, we invested into bonds and gold. And during this rally, people who missed out kept on exiting. The markets went up, and now they are correcting. And in this period, they got a fixed return. They got out of the volatility of the stock markets. And we made this decision purely on the basis of support and resistances. So what are we trying to look at here, we're trying to make a decision on the basis of the upwards and downwards moving of the stock market based on price levels. So mostly, and I'm not saying this being arrogant, but when it comes to supports, in the last, since 2016, so 6 years, in this 6 years, we have picked the bottom 5% support of the last all falls of the market, which are more than 20%. All of them. But fortunately, there have only been 2. So we picked the 2 of the last major falls. The NPA crisis, we picked that. Then we picked up the 2020 COVID fall. However, we did miss the 15,100 was our level for Nifty, and Nifty revived from 15,200 to 17,000 where it is at right now. So can I say we missed this? Yes. If this is a bottom out level, we did miss this. But it's not that we did not invest at all. We invested at different levels. Yes, the market is still above all of those levels. But that very bottom point we did miss if this was the bottom of the market. So has Nifty reached its resistance? Just to give you my current view on this. This is the pattern that I'm looking at. It's called a channel. And in this channel pattern, right now the Nifty is at a resistance. And if the markets keep on trading above 18,000, if it is breached, then it is very likely, if 18,000 is breached, then the market is very likely going to hit a new all-time high. So this is a pivot where I feel yahan pe resistance should be high. Because one, macroeconomics, all the factors are playing against global indexes. Given the things that are happening around us, I will tell you what other things in a minute. It is one of the topics we're going to cover. Plus, as a technical factor, what we see, this is a downwards channel, by the way. Not something I wanted to cover in today's class, but you will be able to see it's higher high. This is a high, this is a low, lower high, higher low, lower high, higher low, lower high. It should followed up with a higher low somewhere here. If it follows the same pattern, if it breaks this, in that case, you will get a new all-time high in the stock market. And the market will likely then move towards 20,000 levels. So this is basically how this whole thing works. Now, hope you got a gist of it. The point that I am trying to explain here is I'm not trying to teach you technical analysis, because it cannot be taught in such a short span. What I am trying to do is I'm trying to help you understand how these decisions are made. It's what is the science on the basis of which these decisions are made. And you'll be surprised to know that technical analysis is 200-year-old study. And the probability for technical analysis to be right is 70 to 80% if a good analyst is doing what they're doing. So this is basically what it is. So the question is, how can you use both of them together? Because you don't have to just use one or the other. You can. A lot of people do that. We like to use both of them together. We use fundamental analysis to understand what we are buying. Is it really good to you or not? But it's a lifelong journey. It's a lifelong journey. The more you learn, the better. It's like a skill. It's like maths. The more you keep on doing, the more better you get. My team has been doing it since 2008. I've been doing it since 2013. So they are more skilled, I can say, in this trade. And but the whole point is that here you can use both of them together, not just fundamentals but technicals too. How do we use it? we use fundamental analysis to find out if what we are buying is fundamentally good. It is something that people aspire to like. This is one thing, which is goodwill. The second factor that we look at is the cash flow models. We look at a matrix that a company is able to create cash flows. A company also does not have a lot of debt, and the company also has inherent growth. So we look at those fundamental factors to see if the company is fundamentally good or not. Then we try to find the intrinsic value of the stock through mostly discounted cash flows. And then after that, we then use technical analysis to look at support levels to buy the certain company at a right price where other people are also wanting to buy, which means from that particular point, the price is going to go up. Because if a stock is, let's say, intrinsic value 100, it's trading at 80, 70, 60, 50, whatever price is trading at, it's a buy for a fundamental analysis. But a technical analyst will only buy at a support level. That is what makes all the difference in the world. Because you could just be picking the bottoms in the stock. There is no guarantee. There's a probability. It's a possibility. We've done it multiple times in the past. But then again, there are times that we buy a stock and it goes even further down. And what do we do in that case? Then we use risk management. We try to ensure the stock does not fall so much that it erodes the wealth. So we use risk management or stop losses when we get out of that stock. So this is the science. Both the science can be conjuncted together along with money management tools like risk management. And that is how the end-to-end game of from researching to analyzing to making the decision to executing to managing the risk, all of those things are done.